Hello, everyone. Thank you all for joining us today for the Silicon Valley Bank Collapse, Understanding Your Vendors' Banking Relationships and Operational Resiliency webinar. My name is Abby Clark, and I will be your host. On your screen, you should see multiple widgets that you can use, including Ask Question, Media Player, Slides, Related Content, Speaker Bio, Request Demo, and Help. If you're not familiar with our webinars, all of the widget boxes are resizable and movable, so feel free to move them around to maximize your screen space. At the bottom of your screen in the toolbar are icon buttons you can use to show and hide those widgets. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right-hand corner of that widget. If you experience these or have technical questions, you can use the Help widget or submit them along with any other questions through the Ask Question widget. Don't worry, we do capture all questions throughout the session. We will be answering some during the webcast, but those that we do not have a chance to answer live, we will address with you via email. Today's live session is eligible for 1 CPE credit. If you wish to receive this credit, please remember to answer all of the polling questions that will appear on your screen during today's presentation. You will also be sent a follow-up survey link 24 hours after the live session that will need to be completed as well in order to receive the CPE credit. And with us today, we have Hillary Jewhurst, VenMinder's Head of Third-Party Risk Education and Advocacy. While no one was prepared for an event like the Silicon Valley Bank collapse, it's important that your organization protect itself from the potential ripple effect that will be caused by your vendor relationships and their banking relationships. In this webinar, Hillary will discuss what your next steps should be, a proactive approach to talking with your vendors, and help you gain a bigger picture of your vendors' financial health and operational resiliency. We will also have VenMinder's Chief Financial Officer, Raman Zachariah, joining our discussion for the question and answer portion at the end of today's webinar. You'll also see a link to a copy of today's slide deck, a link to our website, a link to our samples library, links to The Essential Third-Party Risk Management Guide ebook, Types of Third-Party Vendor Risk ebook, and Third-Party Risk Management Checklist, as well as a link to our library of additional resources and additional SVB resources in the related content widget. So with all that being said, I would like to hand it over to Hillary. Hillary, the floor is yours.
Welcome, everyone. We want to thank you for joining us for this special, kind of unusual webinar today, because today we are going to talk about the Silicon Valley Bank failure. We're going to give you an overview of what happened and some steps that you can take in your vendor risk management program to address potential exposure to these issues. That's going to mean understanding if your vendors are exposed to SVB or other potentially stressed banking relationships. And we're going to review some due diligence questions that you can include on a special questionnaire to gather some information. And we're going to wrap up with some key takeaways. So let's jump right into this. All right, so as everyone is probably well aware at this point, on March 10th, Silicon Valley Bank failed after a bank run. And this was the second largest bank failure in history and the biggest one since that big financial crisis of 2008. So who was Silicon Valley Bank? Well, they were the 16th largest bank in the country, and they were known for really specializing in the technology industry. They did a lot of business with individuals that work in technology, and they were known to lending to higher-risk startups, and they offered a lot of private banking and personal credit lines, mortgages, etc., for tech entrepreneurs. And according to various resources, almost half of U.S. venture capital-backed healthcare and technology companies were financed through Silicon Valley Bank, but they also had a lot of large technology companies such as Airbnb, Fitbit, Pinterest, etc. Okay, so what happened exactly? Well, here's a summary of the quote-unquote official story. So in 2021, Silicon Valley Bank began shifting marketable securities portfolios from a short-term to long-term treasury bonds because they wanted to get higher investment returns. But the value of these bonds decreased a lot through 2022 and into 2023 because the Federal Reserve was raising interest rates to curb inflation. And so what happened is this caused a lot of unrealized losses in their portfolio. We also had that higher interest rates that were increasing borrowing costs throughout the economy. And so some of their clients started pulling money out of the bank just to meet their operational needs. According to their own 10K from 2022, about 89% of their deposit liabilities exceeded that maximum of $250,000 that's insured by the FDIC. So all of these financial stresses were going on, and they had to raise cash to pay these withdrawals by their depositors. So on March 8th, they announced that they had sold over $21 billion worth of securities, that they'd borrowed $15 billion, and that they would have an emergency sale of some of its treasury stock to raise $2.25 billion. Well, that announcement didn't go over well, and there were some very prominent Silicon Valley investors that were giving big warnings, and all of this news caused a bank run. So customers were going to withdraw their funds as fast as they could, and they withdrew $42 billion by the following day. So this is a classic bank run. Everyone going to withdraw all their funds at the same time. So on the morning of March 10th, the California Department of Financial Protection and Innovation, they seized the bank. They said, nope, now you're under the receivership of the FDIC. But within 2 days of the failure, the FDIC really got it together, and they got what's called an exceptional authority from the Treasury, and that they announced then with other agencies that all those depositors would actually have access to their funds the next day. So this is great. They act fast. This is good. But keep in mind, this is something that would not normally happen because you're only insured up to $250,000 per institution, and that's for deposits. But obviously, there's a lot of implications here that cause the FDIC and the Treasury to act in a somewhat unique and unusual fashion. Anytime a bank fails, there are serious consequences. But let's look at some of the examples of the immediate impacts that this failure had. So let's think about all these startup companies. You know, they were not able to retrieve money, so now they were taking out loans just to make their payroll. Now, in California in particular, where many of these companies are based, there's a state law that requires you to pay your employees within a certain number of days. So if you can't do that, you might have to force layoffs or put those employees on furlough or even close the doors. But, you know, it wasn't just these initial little startups. There's a lot of large technology and media companies that were really impacted and affected by this failure, and some of those would include like Vimeo, BuzzFeed, Roku, Vox Media. You know, even the big guys were affected. But another effect, the bank had made about $2.7 billion in loans to build affordable housing in Silicon Valley and San Francisco, and both these areas are in desperate need of affordable housing. They also had another affordable housing project in Massachusetts. So now that they shut their doors, 11 projects in the Bay Area are completely in limbo. Like, nobody knows what's going to happen. There's 2 more of these projects in Los Angeles, and we just don't know what's going to happen with these particular projects, how long they might sit there, if someone else is going to pick it up. So these are some just really immediate examples of those impacts. And unfortunately, we're not just talking about Silicon Valley Bank today. So just a few days later, another bank, Signature Bank, was closed down by state regulators in New York. You know, Signature Bank, if you're not familiar with them, they were really involved in commercial real estate and digital assets, which is that cryptocurrency. They had private client offices in a couple of states, including New York, Connecticut, California, Nevada, and North Carolina. And Signature Bank really got a healthy portion of its deposits from middle market businesses, so law firms and accounting firms and healthcare providers, et cetera. And something else that was pretty unique about Signature Bank is that in 2018, it started accepting cryptocurrency deposits from its customers. Now, hardly any banks do this. But when this bank failed, you know, there were a lot of professional service firms that were really negatively impacted. Most specifically, a lot of law firms use this bank to hold escrow money for their clients. Now, in the case of Signature Bank, Flagstar Bank has now acquired all the deposits and some of the loans, and all of this happened on March 19th. And so all the depositors are automatically going to be transitioned over to Flagstar Bank. And this is great news because they were insured for up to $250,000. But those customers that had deposited crypto assets, guess what? They are not covered by the FDIC, and they are pretty much out of luck. But moving forward, the FDIC will continue to insure those deposits up to $250,000 as they move over to Flagstar. So what does this all mean for depositors? Well, you know, the FDIC and the Treasury, of course, said that they were going to cover the funds above and beyond that insured cap of $250,000. Now, again, I want to point out this is really unusual and a very special tactic that the FDIC and the Treasury took in this instance. And the reason they did that is that this particular set of circumstances represented a systemic risk to the banking system. So they went ahead and they made this move to protect the stability of the greater banking system. Now, I keep highlighting why this is so unusual because we usually only get up to $250,000 per institution, right? That's not per account. And Treasury Secretary Janet Yellen said, yeah, this is not going to be the case for just any other bank that fails. It's only going to be if these banks represent a systemic risk to the financial system. Now, as a depositor, it's really important to understand that the FDIC is going to cover you or your organization up to $250,000 per institution. And, you know, as Americans, a lot of us are well under that amount for our bank account, so it really shouldn't be a problem. But if you as an individual or as a company have more than $250,000 in one institution, you know, they recommend that you diversify your deposits across multiple banks now. But for businesses and companies, you know, they probably do have more than $250,000. So this creates a little bit of a situation for them as we move forward. The one really important thing to note here is that the FDIC does not cover shareholders. So if you had an investment in a bank that goes under, that investment is gone. Now, I can tell you firsthand that last week I got an unfortunate call from my financial advisor that told me I had a very small position in Signature Bank or one of my investment accounts. And yep, I just had to kiss about $11,000 goodbye. So as an investor, you are not covered by the FDIC. And the FDIC doesn't cover any non-secured debt. Okay, now that we have that information, we've got a little bit of background. What does this mean for third-party risk management? What are the questions that we need to be asking as third-party risk management practitioners right now? So the first one is not about our vendors necessarily. The first one is, have we done due diligence and risk reviews for our organization's financial partners? You know, I think it's very common that banks just somehow fall out of scope for third-party risk management. And a lot of programs are just not examining them. They're figuring, oh, it's a public company or it's a bank, so we don't have to worry about it. But clearly, that's not the case. So the first thing is, are we doing risk assessments and due diligence for our financial partners? The next question we should be asking is if any of our vendors are potentially impacted by these recent bank failures, or are they working with banks that are under operational or financial pressures? So are any of our critical or high-risk vendors in immediate trouble? Then we need to think about our vendor relationships in general, and specifically if they had those relationships with Silicon Valley Bank or Signature Bank or any of these other banks that are experiencing pressures. You know, there's been a few more that have been in the news. So what does that look like for our organization? And we need to be thinking about potential exposure through our fourth parties or those vendors that are direct vendors of our third parties. You know, are there any relationships down the line that could potentially impact our organization or our operations? And then finally, what is the plan to protect our organization from this specific situation and others like it that might occur in the future? So while you're thinking about those questions, it is time for our first poll. Abby?
And this brings us to the first poll question of the day. You should see the poll question now in the slides area. If you have any issues, please feel free to send us a message using the Ask Question widget, and we will be happy to assist. As a reminder, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. This poll question is, does your organization include its key financial partners, such as banks, lenders, credit unions, etc., in your third-party risk management program? Yes, some, only specific institutions, no, or you're not sure. And Hillary, it looks like right now we have some time to answer one of the questions that have come in so far from the audience.
Okay.
And that question is, you mentioned that the FDIC wouldn't cover unsecured debt. What is that, and how would that affect my vendors?
Okay. So this is a really important element here because unsecured debt is basically a loan that doesn't have any collateral. So for example, let's say your vendor has a line of credit or a credit card through SVB or one of the other banks. That money is no longer available to them. And why this is important is if they use that credit to fund their regular operations, like they usually to pay their payroll or pay for operational supplies, they could be out of luck right now. And that means that they could have operational interruptions, which can then have a domino effect and ultimately affect your organization. You know, hopefully all these vendors can secure credit somewhere else very quickly, but in truth, SVB was financing a lot of tech organizations. A lot of them were high-risk organizations, and now all those companies are going to be back out there seeking that credit at the same time, and that puts a lot of pressure on the other financial institutions who may tighten their requirements or lower the credit limits, or these high-risk accounts just may not be a good fit for that financial institution. So that's why that unsecured debt really matters. I hope that helps.
Thanks, everyone, for answering that poll question. Here are those results. Before we continue, you may have noticed reactions, such as a thumbs up or a heart, coming across your screen. If you find this feature distracting, you can turn it off by clicking the 4 arrows in the top right-hand corner of the Slides widget, which will expand the slides to full screen and no longer show the reactions. Also, as a reminder, in the Related Content widget, you'll find a helpful resource for you to reference, The Essential Third-Party Risk Management Guide ebook. This guide provides helpful information you need to know about third-party risk management. So with that, Hillary, back to you.
All right, so here is the bottom line. Your organization's financial partners, your bank, your credit union, any kind of lending institution they may use, should definitely be in scope for your third-party risk management program. And as you might assume, your vendor's financial partners should be in scope for their third-party risk management programs. Now, if you haven't thought about this or they haven't been in scope, it's very likely that your key financial relationships, the ones that are most important to your organization, are probably going to qualify as critical vendors. Now, if you need to think about this, just think about the example I used about those businesses that were using these banks to make payroll. You know, what would happen if your organization's bank was to shut or be interrupted? You know, how would that impact your organization? Would you not be able to make payroll or pay for operational expenses? So in truth, there's a lot of operational risk when it comes to our financial partners. Okay, so now we're really starting to understand the potential impacts of this situation with they are now and could be in the future. And this means that we really have a good opportunity right now to synthesize all this information into action and really take the appropriate steps to identify and mitigate risk. So even if your organization is technically safe from all these bank failures and pressures, just taking these actions can really help you improve your organization's operational resilience. So what are the actions that you can take? Well, let's start with the immediate issue and that exposure to Silicon Valley Bank or those other banks. One of the very first steps you can take is to go to your accounts payable department and ask to see a list of the bank accounts where you pay your vendors. Now, this is only going to work if your organization is paying directly to a bank account versus a remit to address where they process the check offline. But once you have that list of receiving financial institutions, look for Silicon Valley Bank, Signature Bank, or other banks that might be a concern. And you definitely want to start this exercise with your most critical vendors and then work down through your list. Now, if you have vendors that are utilizing SVB or other banks of concern, one of the first things I want you to consider is doing a full due diligence review, even if it's off cycle. The impacts from an event such as this can not only have many tentacles, they're going to touch many different areas of risk at your vendor's operations, but they can also happen really quickly. So we're going to have to get some information and do some due diligence. And during this process, we really want to understand and focus on vendors' financial health and any other risk exposure. So operational risk, for example, that might be related to this event or related to this type of event. And that is, we have to look at their business resiliency and disaster recovery and even think about compliance right now. So again, think about those organizations in California that had that pressure of the law to pay their employees on time. That lack of money, that lack of funds could really impact the vendor's ability to comply with specific laws or regulations. So while you're putting together all your new due diligence and interim questionnaires, we understand that's going to take time and effort, and it's not going to be immediate. But in the short term, in the immediate term, if you are not using them now, I strongly suggest that you engage some vendor risk monitoring and alert services, as they can really help you keep track of developing new financial health and monitoring, as well as many other risk domains. These are real-time tools, so they can help your organization be informed of stuff that you might need to act on right away while you're still getting your point-in-time assessment ready. Now, if you've been to any of my webinars in the past, you know that I often suggest these services as an add-on or nice to have. But in light of current events, I think they're almost mission critical now, because we are just not going to be able to successfully identify all the potential risks and actually monitor vendors specifically by just setting up a Google News alert. So if you actually have a vendor that has had exposure to Silicon Valley Bank or another bank, it's important that we take steps right now to identify and understand the risks so they can be managed. Now, we talked a few slides ago about the importance of due diligence and making sure there's a full due diligence review. And the reality is we just can't shoot out, 20 due diligence reviews at one time. We all know this takes time and effort to plan. And then we're depending on the response of the vendor. So in the meantime, you can send out a sort of a mini vendor risk questionnaire specific to financial health. Now, taking the time to collect this information as an interim measure between due diligence reviews is only going to help you identify where you need to focus first. So we'll talk about some things to include in that questionnaire shortly, but I feel like it's really important to discuss how to make this effort successful, because we really need to get the information, and we need to get it as quickly and as seamlessly as possible. So to set expectations, the first thing to understand is that this effort is going to take some very deliberate and careful planning and preparation, because we cannot afford to have a lot of rework. We don't want a lot of back and forth. We need to get this information as quickly as possible. So here are some recommended actions. First thing you need to do is create that prioritized list of your vendors. We need to do this so that we can understand both the work effort and the timing that we're looking at. And we also want to make sure that we have that information put together for our senior leaders and board so they know who we're focusing on first and what the plan looks like overall. Next, we have to develop that supplementary vendor risk questionnaire that's going to be dealing specifically on these financial questions, financial health questions, etc. And we want to collaborate with our SMEs to do that, because we need to make sure that this questionnaire is comprehensive. And we also need to work with our subject matter experts to understand how much bandwidth and capacity they're going to have for these additional urgent reviews, and what's that going to do to our existing due diligence queue. How much can we handle at any one time? Now, this is really important because we're going out and asking for all this information. But if there's no one available to analyze and assess those risks, we're going to have a major bottleneck. So we need to know that we have somebody who can actually do the work. Now, if it turns out there's going to be too much work for your existing SMEs, then we need to consider outsourcing these vendor risk reviews. And, there are a number of third-party risk management service firms that can provide this service and that additional subject matter expertise to help you get through those risk reviews in a timely fashion. Let's remember that this is kind of an urgent situation, so we really need to assess our capacity and secure more capacity if necessary to make sure we get through these reviews in a timely fashion. We can't wait a long time to figure out that, for example, one of our critical vendors might be in trouble. The next thing we want to do is we want to notify all the vendor owners of this specific issue. A lot of them may have heard about it, but they may not have connected the dots as it pertains to their vendors. So we want to make sure that they understand the details of what third-party risk management is doing, the next steps, and we want to emphasize their participation in the process. So if we can't get something we need from a vendor right away, then they need to be the ones following up and hounding that vendor until we get what we need. And speaking of vendors, we need to prepare a specific letter for the vendors because we want to help them understand why we're taking these specific measures right now, especially if they're used to just, an annual review. Then all of a sudden, mid-cycle, we're asking them for this new information or just specific pieces of information. They really need to understand why, and they also need to understand our expectations for acting on this request and returning the information. We also need to provide them with the specific timing for returning that information and give them an internal contact that they can reach out to if they have any questions. We cannot forget to put together an update for the senior management, the risk committee, or even the board if necessary about this specific issue and let them know what actions are being taken, what the timelines are, and if we've identified anyone who's at risk right now. We just want to make sure that they are in the loop because it is a pretty big deal. We also want to continuously keep people updated, so we are going to need to develop some reporting specific to these efforts so that we can share that with the stakeholders, senior management, and the board if they need it. Once you have all your ducks in a row, you can really start distributing and start tracking those questionnaires. So let's take a minute to look at some sample questions we might want to include on those questionnaires. So obviously one of the first questions we want to ask is who does your organization bank with, and if they are banking or had banked with SVB or Signature, what are they doing to maintain their deposits? If they're keeping with the receiver bank or they're moving it somewhere else. We also want to ask if the organization holds all its funds or deposits with one bank or multiple banks. And if it's multiple or even one, we need the names of those institutions. We also want to know their latest cash and cash equivalence balance and liquidity position. And beyond those cash and equivalents, we need to know what other sources of liquidity and funding they may have. So if they can't get their cash, what kind of liquidity and funding can they access? Do they have other credit lines or loans, et cetera? We need to understand if their funds and deposits are being held domestically, so here in the United States or internationally, maybe they have some cool Swiss bank account, or they're doing offshore banking in Nassau or the Caribbean somewhere. And here's the big money question we need to ask our vendors is if they've performed any due diligence, typically financial health assessments on their banking partners, right? So have they done the work? Do they have any restrictions on accessing their cash or cash equivalents? So do they have any early withdrawal penalties, or are they only allowed to take out so much at a time? Of course, we need to know if these recent banking failures have affected them or one of their banking partners. And if so, is it going to cause any delays or difficulties fulfilling their obligations to their customers? And if so, what are those difficulties or impacts? We need to make sure that our vendors are doing the same exercise for their vendor base. So are they getting financial health data from their vendors related to their bank failures? So these are just a few important questions you can include on the specialized risk questionnaires. But like I mentioned earlier, please make sure you collaborate with your financial health subject matter expert to really make sure that you've covered all your bases. They will probably have some additional insight or have more information that has surfaced recently, and we want to just make sure that's reflected into the risk questionnaire. Okay, so now let's turn our attention to what does the situation teach us about third-party risk management? Well, I hate to say it, but in one way there may be a silver lining here, as it relates to these bank failures and third-party risk management. Now, hear me out. As third-party risk management practitioners, we've had such an extreme focus on cyber risk and business continuity risk over the last couple of years that we may not always be paying as much attention as we probably should to financial health. And these events really highlight the need for that really robust due diligence, especially when it comes to financial health of the vendor. We can also deduce from this situation that we have to do those periodic risk reassessments and continually update our due diligence, because what was true about our banking partner or our vendor 6 months ago, may not be true now, and those controls and financial positions may be out the window. And with that, ongoing monitoring is essential. And now more than ever, those risk monitoring and alert services and tools may be the differentiator between success and failure for your third-party risk management and your operational resiliency at your organization. Now, I'm saying this because the truth is we just cannot keep track of all these vendors all the time using things like Google News alerts, because they often give us a lot of irrelevant data or outdated data. So if you're not currently using these services for monitoring financial health, cybersecurity, et cetera, I really encourage you to have some discussions with your manager and your budget officer to see if it's possible to secure funds for these services, because they feel like they're absolutely going to be a lifeline right now. And of course, the other thing this teaches is that we have to have our banks and financial partners in scope for our third-party risk management programs, and we should expect that our vendors do the same. One of the ways we can do this is to make sure that our critical and high-risk vendors, that we are including a review of their third-party risk practices and controls as part of due diligence and periodic risk reviews. Whew. All right, we've taken in a lot, so let's take a short break for our next poll. Abby?
Our second poll question of the day is, our organization has identified those vendors who had SVB or signature bank relationships. Yes, in progress, we're planning to review, no, or you're not sure. Hillary, I have another question here that I think we can go ahead and answer.
I'm ready.
Awesome. That question is, if the FDIC is going to ensure all the deposits are available, even the ones that are more than $250,000, then why do we need to worry about this?
So the key word here is deposits, or that money that already belonged to the customer. So yes, those customers that have deposited money into SVB, the FDIC is going to make sure that they have access to those deposits. Now, again, just like our last question, we still need to worry about these bank failures because many businesses depend on these banks for capital and lines of credit. So many mid-sized and small businesses depend on those loans just to operate. So now getting that capital or lines of credit may be really difficult, especially with these very high interest rates, and it just may be out of reach for some businesses. So that is one of the reasons we need to worry about these bank failures, even if the deposits are covered by the FDIC. I hope that helps.
Okay, here are those results. Thanks again, everyone, for taking the time to answer the poll. I would like to quickly direct your attention to the related content widget where you will find our types of third-party vendor risk ebook that's available for download. This helpful resource will walk you through all the different types of vendor risks to be aware of. Okay, Hillary, let's continue with the presentation.
All right, so today I've talked really fast and I've given you a lot of information. What it all boils down to with these bank failures, you know, it's all about operational risk. And the thing that we always need to remember is that operational risk touches a lot of areas. And the best way to identify and manage these risks is to have that really solid vendor risk management framework so that we can identify and assess and manage those risks. But beyond having the perfect framework, we need to make sure our stakeholders and our subject matter experts, and most importantly, our senior leaders, are really there to support and champion these efforts. We need to make sure that the work is prioritized in the organization and that it's executed appropriately. And we need to know that when internal folks are not complying with these requirements, that it's going to get escalated and that we're going to get some action. And if you need a refresher, here are 10 situations or examples of where we might encounter operational risk. So the first one, of course, is the regulatory environment. Anytime there's a regulatory change or an update, we're going to run the risk of not being compliant. And you know that applies to our vendors as well. So we need the mechanisms in place to address this quickly. Currency fluctuations are another big one. So if you're doing business internationally or you're processing transactions or your company has investments abroad, this can really affect your operations just like societal or political changes. You know, if there's a conflict, if there's a lot of corruption, wars, terrorism, all these things can impact your operations as well. Inflation, well, we all know about that one. We're all feeling it personally, but as you know, these higher interest rates reduce not only our own access to credit and limit our buying power, but that's true for our organizations as well and our vendors. There's several others such as taxes, consumer taste, but last but not least, there are financial pressures or systemic financial risks that affect all of us and our organization's operational capacity. All right, bear with me because this is going to feel like when you get on an airplane and the flight attendant starts telling us something to reinforce what we already know about safety. But here I go again. We're going to review some information about operational resilience and business continuity. We need to make sure that the contract really covers business continuity and provides for that continuation of the business function, especially if there's an interruption or degradation that happens for any reason. It could be natural disaster, human error, intentional attacks, or systemic bank failure. We want to make sure that our contract covers backing up and protecting all of our internal programs and systems as well as backing up the data. And we need to make sure that there's regular maintenance that addresses cybersecurity issues. So, you know, making sure they have good patch management process, that they're doing regular testing, etc. We want to know that they maintain current business resumption and business continuity plans and that those plans are good. And that's the key word here because we need to make sure that the plans have been tested because the plan is only as good as its results. And of course, we have to review and monitor those fourth-party business continuity plans for those fourth-party vendors that could potentially impact our operations. You know, we may not be in the position to do that, or there's not a lot of cooperation, but we still need to make sure that our direct vendors can attest that they are doing that and give us some evidence that they are. It's true, we all know that operational risk exists and we can't eliminate it completely, but what can we do to really reduce the likelihood or lessen the impact of the operational risk? Well, the first thing, of course, is to have that third-party risk management framework that really follows the third-party risk management life cycle, because we want to systematically identify, assess, and manage that vendor operational risk throughout the relationship, not just when we're onboarding. We also need to make sure that our risk identification methods are really built to address any complexity or criticality of the products and services provided. So we might need to be a little bit more in-depth and put some of these more complex products and services through a more stringent risk analysis. We also need to make sure that due diligence is thorough enough to really identify any gaps in the vendor's environment. And when we do find those gaps, we need to be able to understand what can potentially be mitigated or managed so that we can determine if the residual risk or that leftover risk is going to be acceptable. We need to do all of that before we sign any contracts. And speaking of contracts, we have to make sure that we treat that contract as one of our most important risk mitigation tools. Now, we can set up legal obligations within that contract to incent and obligate our vendors to have specific risk management practices and controls. So don't forget about your contract as a risk management tool. We also need to constantly monitor their performance as well as their risk. Now, you've heard me say it before, but declining performance is often an indicator that there are hidden new or emerging risks. So make sure you're looking at their performance as well as the risk profile at least once a quarter for all your high-risk and critical vendors. And if you're feeling like there's a lot of resistance to these activities, you definitely need to get that tone from the top to help support and enforce these requirements. So we really need to engage our senior leaders to act as advocates for the vendor risk management practices, and if necessary, even help us get more resources to make sure that we really get the job done effectively. When we're trying to address that vendor risk, and the first one may be obvious, is we have subjective or inefficient risk identification. So maybe we don't have good standards, our identification methodologies are really not up to par. That's when we're going to have a hard time doing risk identification effectively. Maybe there's an incomplete review and assessment of due diligence documents, or they're not being reviewed thoroughly, and they're not being reviewed by a subject matter expert that has the necessary experience. I cannot emphasize enough the importance of making sure that you have qualified individuals reviewing those due diligence risk questionnaires and due diligence documents. Now, a qualified SME is going to have a lot of professional experience and credentials in their risk domain. And these people can be internal or external, they just have to be qualified. Another very serious issue is when we only use that first risk review and due diligence to set the vendor's risk profile. You know, we're not going back and doing any periodic reassessments or monitoring. And this is a big problem because that's the point in time. Vendor risk changes all the time, and we cannot depend on initial due diligence to inform us of the vendor's risk. Now, while it's really important to have standard terms and conditions you want to include in every contract, such as right to audit and cybersecurity protections, it can be a real derailer to use boilerplate contract templates that aren't really considering those specific risks for the product or service. They're not really taking in the complexity of it. Signing that contract before due diligence is completed, I've said it once, we'll say it again, you are losing all your negotiating power when you enter a business relationship before you have correctly identified and managed the risk. If you're not monitoring vendor performance, their vendor control environment, or you have a lack of appropriate and timely monitoring risk reviews. So you're supposed to be doing it every quarter, but maybe you're doing it like every 18 months. That's not okay. And then the last thing is poor record keeping and storage, right? We don't know what's been reviewed. We can't find the documents. We don't have good communications, etc. And I know I've been hammering on this drum for the whole hour, but I want to reinforce that one of the biggest issues we can have, one of the biggest derailers, is when we don't have that supportive senior leadership for a third-party risk management program. You know, if your senior leaders aren't out there being active champions, if they're not talking about third-party risk management, if they're not considering third-party risk as part of the overall business strategy and decisions, and they're not enforcing any of these requirements, this is a huge problem. And it's not uncommon, I'm sorry to say, and usually when we're in this situation, all it takes is one really bad vendor incident or regulatory finding for those senior leaders to sort of wake up and understand that they play an instrumental part in the effective and successful execution of third-party risk management. So if you're struggling with that, please work through your management chain, try and reinforce and ask for that commitment and that tone for the top. All right, we are ready for our last poll question of the day. Abby?
Our last poll question of the day is, does your organization plan to perform additional vendor due diligence or vendor risk reviews due to recent bank failures? Yes, plans are underway. Yes, plans are in development. Probably. No, or you're not sure. And Hillary, let's go ahead and answer another question from the audience.
Okie dokie.
And that question is, what if we do have a vendor who had ties to SVB? Do we need to replace them?
Well, I think before we start canceling our vendors, the most important and prudent thing to do is to perform your due diligence and get more information from them. They may have been an SVB customer, but maybe they have very low exposure. They just had a deposit account. Or on the other hand, maybe they aren't in good shape and are losing that SVB credit line is going to have really dire consequences for them. But the important thing here is we can't assume anything until you have the facts. In any case, your organization still needs to have a plan for what you will do if that vendor goes out of business or can't provide those products and services to your organization. So I would say that if a vendor isn't critical to your business and it's possible to be a little flexible while they get their finances secured, to just work with them the best you can, because it's a lot of effort, time, and money to replace a vendor. So for example, if that means maybe you change your pay terms from 60 days, now you're going to pay them in 30, I'd see if you could go ahead and do that, because these are really hard economic times. And your vendors employ people, and every job lost has a ripple effect on the whole economy. I do want to point out that never means that you have to jeopardize your business in any way. But if there's room to be flexible and they've been a good vendor, just see what your organization can do. Just make sure you keep a close eye on the situation and know your limits. Hopefully a lot of these vendors can get their financing needs elsewhere and things can stabilize quickly. But that's my recommendation there.
And here are those results. Thank you to everyone for answering this question. It's always interesting to see what everyone says. Also, I'd like to mention that you'll find our third-party risk management checklist available for download in the related content widget. Use this resource to ensure you're collecting the correct due diligence documents and taking the right steps in third-party risk management. Hillary, I'll pass it back to you.
Okay, let's wrap up with some key takeaways here. So first of all, the situation is still evolving. We've put a cork in it for now, but we need to stay alert. So make sure that you can set up some Google News alerts, read the information on the regulators' website, pay attention to this issue the best you can so you don't have any surprises. Make sure you review your vendor base for any exposure to the closed banks or any potential exposure from banks that are under pressure right now. And if you're not doing it yet, make sure you pull your organization's banking relationship into your third-party risk management program, right? They do need full due diligence and risk assessment just like any other vendor. Keep your vendor risk questionnaires updated to include these expanded questions about banking relationships and other financial practices. You know, right now we might be issuing this little short questionnaire as an immediate step, but as we move forward, make sure to integrate those questions into your regular questionnaire so it becomes part of your regular cycle. Review business continuity plans and test results for your critical and high-risk vendors. Make sure they've tested the plan. And another really important element here is to make sure that you're reviewing your vendor's third-party risk management practices. This really does need to become another standard due diligence element, especially for your critical and high-risk vendors. And as usual, vendor risk is always evolving, so we need to make sure our programs and practices are evolving also. So that concludes our presentation today. I hope it's been helpful. I hope that you've been able to gain some insight onto the situation and that you can go away thinking about what needs to happen in your own third-party risk management program to address these issues. I want to thank you very much for your time, and I'm going to turn it back over to Abby for some more information and some Q&A. Abby?
Great. Thanks so much, Hillary. Before we dive into more questions and answers, I want to thank everyone for attending. I would also like to thank Hillary for her time and sharing some really important information. On your screen now, you will see our upcoming webinars. This afternoon at 2 p.m. Eastern Time, our Vendor Financial Red Flags Your Credit Union Should Watch For webinar. On April 4th, our Fourth Party Risk, What to Know and How to Manage It webinar. And on April 18th through the 20th, our 3-day virtual third-party risk management boot camp. We hope that you will be able to join us for those sessions as well. A link to register for those sessions is in your copy of today's presentation slides. Let's now go ahead and answer some more questions that have come in during this session. Okay, great. The first question I have here is for Raman. Raman, this question is, do I need to send out this special financial health questionnaire for every vendor?
Thanks, and that's a good question. Given how varying the size of your vendor base is, the answer is it depends. But to make the most of your time, you should ensure that you should be sending your questionnaire from a financial health point of view to at least the most critical vendors that are within that varying size vendor base you all operate under and obviously look forward to operate under. From there, whatever time you may have available with the limited resources time that you guys are all operating under, you can work through the remainder of your vendor list by order of criticality. So always keep criticality in mind to get the best bang for your buck. You obviously want to perform the proper due diligence on banking relationships of these vendors, as well as just general financial health and stability and some of the things and best practices we talked to. So make sure you get a readout on the risks that come from these reviews, and then perform any sort of additional mitigations on those issues that are identified. Should there be some sort of issue in the banking institutional relationship that they have. Obviously, at the end of the day, it's always good to inquire about the relationships from a banking point of view that these vendors may have. So keep that in mind when you're performing all of your standard due diligence workflows. Keep it as part of or regular financial due diligence and overall due diligence cadence flow, and use that as a best practice again to focus on the most critical to start, then go down the list, and obviously try to work to mitigate those risks that are found thereafter. Thanks.
Awesome. Thanks so much, Raman. The next question I have here is for Hillary. Hillary, this question is, how can we avoid exposure to these types of situations in the future?
Well, I think it's not about avoiding exposure, right? Because the risk is out there. You can't really tackle all of the complexities that, create these types of risks on your own. I think what's important here is to focus on your visibility and awareness of them, and really being able to identify how these types of scenarios, this type of risk would impact your actual organization. and doing the practical and tactical things you can to sort of reduce the likelihood, or the impact that those risks can cause. So I think that's kind of the thing. We can't totally avoid exposure, but we can understand the risk and prepare and plan for it and try and mitigate it the best we can.
Wonderful. Thanks, Hillary. This next question here is for Raman. Raman, this question is, are there specific contractual obligations or SLA language we should include in the contract to make sure we can get information about a vendor's banking relationships and overall health?
Another good question. And yes, I think to sum it up, your contracts and the language within them can be your best friend as it relates to your overall third-party risk management program, and also having your vendors essentially cooperate with you every step of the way of your due diligence, regardless of whether or not you're focusing on doing due diligence on their banking institution relationships, their financial health, or other areas within your TPRM or third-party risk management program. So inserting language within your contracts, such as some visibility or ability to audit the vendor's financial health, and this could be as simple as requiring the vendor to provide you with annual documentation as it pertains to their financial audit that they perform, or any sort of company prepared financials is important. You can also get a letter from their CFO or other folks on their executive team to show that they have adequate liquidity or access to capital and liquidity to fund their ongoing operations. So look to insert those types of language or those types of SLA clauses as you're preparing either a new contract or looking to renew existing vendor contracts in your overall program. On top of that, and in addition to some of those contractual clauses on due diligence and receiving information, you can always add some sort of exhibit or some sort of appendix to your contracts to give you the ability to create a dispute process or an inquiry process if you believe that there is a need for you to double click into or dive deeper into certain areas of their overall risk management profile, again, specifically in this case, focused on their financial health. So consider adding something like that and working with their support side to perhaps escalate these types of issues and questions and get them resolved within a certain SLA time period in order for them to remain in compliance with whatever contractual provisions and terms you have put forth. So think about, again, your contracts as your best friend, but also as something you should look to enforce and not be afraid to enforce, regardless of whether or not there is an issue. You should always use those contracts and the language within them to help protect your organization in any given cadence.
Wonderful. Thanks so much, Raman. This next question here is for Hillary. Hillary, this question is, what if my vendor will not disclose the requested information?
Yeah, I mean, this isn't just an issue with these kind of like urgent requests. This is something we go through all the time with any due diligence request, unfortunately. But here's some important things to understand. First of all, setting up the expectation with that vendor, right at the beginning of the relationship, prior to asking them for those documents, is that, our ability and desire to implement a contract with you is contingent on validating your risk practices and controls. So that's the first thing they need to understand. Now, even if you clearly explain that, there's always going to be pushback. But one of the things you can do, especially in this situation, is really just simplify the request. Ask them to escalate it to a higher level of the organization, or you go ahead and, contact the higher level of the organization if possible. Now, here's the other thing, too. With this particular situation, when it comes to these bank failures, we're hearing a lot of people say, oh, I asked my vendor and they said everything was fine. Well, yeah, SVB thought everything was fine, too. We need to be in a trust but verify mode here and that really means that if they cannot provide you the information as requested, that they should be suggesting and providing alternative ways that you can validate that. So put the onus back on them, because this is really about them proving to you that they have a control. I hope that helps.
Awesome. Thanks so much, Hillary. Unfortunately, that is all of the time we have left for questions today. Thank you, Hillary and Raman, for taking the time to address some of those that came in. Any of the questions we did not have time to answer live today, we will address with you offline. We would like to thank you all for attending and hope you found today's session valuable. A big thank you to Hillary as well for her time and great content. And ask even more questions inside of our third-party think tank, an online community that is dedicated to third-party risk professionals and free to join. Just because today's session has ended doesn't mean the conversations and the questions must. Go post your questions at thirdpartythinktank.com and see what your peers have to say. In the community, you'll find thousands of free educational resources related to third-party risk management topics to assist you. If you'd like to become a member of the third-party think tank, you can register on the site or just let us know and we will send you a link to set your password. We did record today's session, and that recording link will be provided to you in a follow-up email that you will receive tomorrow afternoon. Also within that follow-up email will be the survey link for you to request your CPE credit. On behalf of VinMinder, it has been a pleasure. We thank you and hope you have a great rest of your day.